Well, thanks a lot, Dr. Rai. Thanks to UT and the Energy Symposium for the invitation. It's great to be here. Hopefully this will be a bit different than the story you hear about coal, certainly in the popular media and probably in most academic contexts. I'm going to try to convince you of a couple of things. One, that maybe coal's not sexy, but it's pretty damn interesting. Two, it's certainly the leading cause of climate change. That is something you will hear a lot in the public media. But the second piece of that I think is very much underappreciated is it is arguably the leading opportunity for carbon mitigation in the world. So that's the second piece of the story that I think is really not appreciated and increasingly needs to be appreciated, particularly because we're in a real moment globally that is more or less a sort of vacuum for climate policy. Sort of broadly speaking, a sort of post-Kyoto era. We can get into Kyoto a bit during the talk and perhaps after, but most of you probably know the existing Kyoto Protocol really winds down in 2012. Current negotiations for extension are not really going anywhere. U.S. carbon policy stalled. A few developments around the world which we'll touch on, but I think we're at a moment where we need to think about global energy markets and climate outside of the dialogue that's been really dominating for the last 10 years, which is let's put a price on CO2, let's have cap and trade, let's have the EPA handle it. So you won't hear much of that from me. Hopefully what you'll hear is a pretty direct, hard-hitting look at energy markets and what we can do in energy markets without thinking in those old frameworks of cap and trade and climate policy. So just to kind of indicate where I'm going to go today, I'm going to start out looking at just the fundamentals of coal, kind of where it sits in the world energy supply and how that relates to climate change. Once we establish that, what I'll do is drill down a bit on the world coal markets just to show you what's going on, how they work, how they're evolving. Third, we'll really drill down on what I would say is the epicenter of the world coal markets, which is the Chinese coal markets, which are probably the most important piece of both the coal and climate challenge that we'll hit on today. And then four, what I'll offer is a few ways of thinking about these challenges, again, outside of these frameworks that have kind of dominated the dialogue for the last 10 years. So starting off with the fundamentals, you've heard a lot about renewables, you've heard a lot about nuclear lately, but guess what? The last 10 years was coal's decade, okay? If you add up every single source of energy combined except for coal in the last 10 years, it barely contributed more to world energy supplies than coal. Coal is the dominant answer to world energy demand in the last 10 years, and the fastest growing source of fossil fuel for the last 10 years running. Where does that put coal today? It puts it at about 30% of world energy supplies. So it's only behind oil in terms of its contribution to global energy supplies. And as I indicated, it's been on the rise at a highest share of world energy supplies since 1970. Which countries really account for the biggest coal markets? No surprise here. China at just about half. The other major players, US number 2, India and the EU kind of vying for 3 and 4 there, and a number of other key markets, which we'll touch on a bit, and are the subject of a number of Stanford studies if you want to drill down in more detail. So why have we seen this massive surge in coal demand, and why is coal really the answer to world energy demand in the last 10 years? Well, the developing world is essentially predicating its development and its industrial development on coal. These economies are fundamentally coal-fired, and we saw something pretty incredible around the middle of the last decade. Coal actually overtook oil as the leading fuel for development in industrializing economies. So as you can see there, coal breaks ahead in 2006, and the gap in terms of coal over oil is pretty steadily increasing. And I like this quote at the bottom from Robert Zoellick, who is the current or former head of the World Bank. And I think he sums it up nicely when he was talking about the rather controversial World Bank loan for a South African power plant. Some of you may have seen the debate over that in the news. It'll be one of the largest point sources of emissions in the world. And there was a big fight, can we do renewables, can we do nuclear? But at the end of the day, guess what it came back to? Coal is still the least cost, most viable, and technically feasible option for meeting the base load power needs required by, and I'll substitute Africa for, the world's developing economies. And that's still the case, and that's just really a fundamental driver for the markets and the emissions patterns that we're going to talk about in this talk. So I said this is important for climate. I'm going to make the claim coal is the most important thing for climate. If you care about climate change, yes, renewables are important, but coal is more important. 43% of all emissions, all CO2 emissions that is, not total GHGs, are from coal. It is the single biggest piece of the climate challenge. So if you want to think about climate, you've got to think about coal. So we saw that currently we're at 43% of CO2 from coal. Where are we going? Where do the world's leading emissions models think coal fits into this puzzle as we go out to 2035? Climate change, obviously, is sort of a long time horizon problem. Well, if you see that wedge in the middle, where are global emissions going to come from? This pattern is only going to get more pronounced. The center of the climate change problem is coal in developing countries, and that's going to account for the largest block of CO2 emissions in the world out to 2035. So we kind of now have framed the problem. What is climate policy doing about it? Not much. That's the answer so far. So as I mentioned in the beginning, Kyoto, unlikely to be extended in any meaningful form. We can get into that a bit later if necessary. The concept of the legally binding global treaty, I would argue, is really dead and really doesn't have a role in the world that we live in. This idea that Kyoto was based on of common but differentiated responsibilities, which essentially said the industrial nations were responsible for historical emissions, therefore they do all the historical lifting. Developing countries do nothing but accept checks in mechanisms like the Clean Development Mechanism, really doesn't work in a world where all of the emissions growth and all of the economic growth is coming from non-OECD economies. And that's not my personal opinion. That's really where the negotiations are today. They're deadlocked around those kind of principles. In the EU, we do have a meaningful carbon market. Carbon at a low for the last 3 or 4 years here, about €9 last time I looked, which was really decarbonizing and is decarbonizing the EU power sector. But the nuclear issues globally and in Germany are going to basically cause a bit of an uptick in coal demand as folks look to substitute baseload power from nuclear that comes offline. China, there are a number of energy intensity and climate targets there. I won't go into immense detail right now. USA, I think most of the folks in the room are probably familiar with where energy and environmental policy is in the States. I think, for those of you who follow carbon markets, the Regional Greenhouse Gas Initiative is a cap and trade market for the power sector in the Northeast. That's actually probably coming backwards and retracting as we have a number of governors saying that they're going to pull out. $2 a ton for CO2 is too expensive in the current political climate. So we do have some movement in California. That's something we can get into again in more detail later, and something we spent some time looking at Stanford. The AB 32 cap and trade market in California was slated to start at the beginning of 2012. It's been delayed to 2013. Probably a good thing so the state can get its ducks in a row and avoid problems down the road. And then, of course, Australia and New Zealand. New Zealand with a nascent market, and Australia attempting to pass sort of a tax that will phase into cap and trade later. So again, we've framed the problem here, and what I'm trying to argue is that the solutions that we've been talking about for the last 10 years really aren't moving forward in the way that would require to address this problem. And if coal really is the heart of this problem, then we can start with the premise that to address it, we really need to understand the coal markets. So that's where we'll go in the next section. And thinking about the birth of globally traded coal markets. There really were no globally traded coal markets in the mid-1970s. What happened was we had 2 oil crises, right? Oil spikes to an all-time high, and the world sits around and goes, what are we going to do to get oil out of our power plants, right? We don't want the price exposure to oil spikes, and we don't want the security exposure to the OPEC cartel. Well, this is sort of a massive global energy arbitrage that is a huge shift in the way the world consumes energy starts at this point, because it's really the world deciding to swap oil out of its power plants or oil products and put coal in instead, because there's a huge price differential and a huge security differential. So coal becomes the default answer for new power generation globally after the Arab oil crises. And I like kind of going back to like 1979. And if you look at what people were saying then, here's what the head of the International Energy Agency was saying in 1979. The uses of coal are limited only by our imagination. So I haven't seen that one in a press in a while. Such a market could ultimately develop in a similar fashion to the international oil market. Well, what happened? Imagination became reality. The blue on the bottom is global steam coal market. Steam coal is the coal used to generate electricity in power plants. Coking is used in the steelmaking process. The steam coal trade multiplied by over 5 times since the Arab oil crises. As I said, coal really became the default answer, and the globally traded coal markets exploded. Here's what they look like today. And what's happened as the globally traded coal markets have expanded is they've started to connect previously regional and isolated markets. Okay? So a good analog in some ways is what's happening right now with LNG, for those of you who follow gas. But just to give you a few examples of how this plays out, in 2008, European coal prices were approaching an all-time high. What happened then is U.S. coal on the East Coast started getting sucked into Europe because of the arbitrage there, right? And what's happening now is Asian coal prices are at all-time highs. So U.S. coal producers are trying to figure out how to send the massive amount of cheap coal reserves in the western U.S. in an area called the Powder River Basin and export that through the West Coast into Asia. And that's actually been getting a lot of press because the climate movement of late has opposed that. I think the logic there has been a bit fuzzy, and we can get into that later if you like. But these are examples of how world trade and global prices in these now liquid markets are connecting what were previously domestic and isolated markets through arbitrage. China is another key example. Last year, China's imports, while not significant compared to their own domestic market, accounted for 15% of globally traded steam coal. So what that's actually done is linked the global price of coal to the internal price of coal in China. And we're seeing these connections increase as we get closer and closer to a true world coal market. What else has that meant? I'll argue that coal is really on its way to becoming a financial asset, much the way that oil did. So for those of you who followed the debate about the spike in oil prices in the last 5 years, there's certainly an empirical fact that not only is the derivatives trade in oil much larger than the trade in the physical product, that financial products which have been built on top of the oil markets have not only increased in size and assets under management, but have had controversial impacts on the price of oil itself, which we can get into again later. But what I'm arguing about coal is where oil was roughly in the late 80s, early 90s. Just as futures trade started for oil in 1983, that's when the NYMEX WTI contract started, coal is kind of going through a similar financial transformation from a raw industrial physical commodity to a financial product that's traded by the world's leading banks and hedge funds. So how did that work for coal? It started out, if you asked somebody in 1985 what the world price of coal was, you wouldn't have been able to find out because it was all traded in long-term contracts between bilateral entities. Then you have deregulation of the European power sector. And all of a sudden, spot markets for coal start to emerge. Once the spot markets got liquid enough, you could start to have price benchmarks where you had somewhat transparent pricing in world coal markets. Once you had somewhat transparent pricing, you could layer derivatives on top of that. And we saw the emergence of derivatives in coal in the late 1990s. Then in the late 2000s, what we had is what you see here. Global coal contracts start to go on to the world's major financial exchanges. For those of you who follow energy commodities, ICE is a major commodities exchange, coal now moving on to those exchanges and gaining an open interest, much the way oil did in the 1980s. So before we kind of move on past world coal markets, we've kind of mentioned the arc of where they've gone and how they emerged in the last 20 years. I just want to highlight something that I think is an emerging question right now. As you see, I've got the bottom right highlighted there, and that is fundamentally something we haven't seen before. What is that? If you look at the red line on the bottom, that's Henry Hub gas on an energy basis in the US. Now the blue line there and the orange line are essentially the major Asian coal price indices. Now these are all in equivalent energy terms. So what we see here is that for the first time really in history, a major global gas contract is cheaper than major global coal contracts. That is not in itself a sign of anything serious yet, but is something I think we need to begin to watch as we think about how this coal story and this unbelievable momentum we've seen in the last 10 years might change in the next 10 years.
Richard, could you just tell us what the different votes are?
Yeah, sorry. So I don't have a pointer here. So everybody pretty familiar with dollars per MMBTU. That's just dollars per unit of energy, right? So these are a lot of the major energy contracts in the world. And I've got another slide that drills down on this a bit in a second. But Brent is, I would argue, the major global oil benchmark right now. Henry Hub, US gas. NBP is European gas, UK gas. That's traded. The rest of continental European gas is mostly oil-linked. We'll leave that aside for a second. PRB is the cheapest US coal that's mined in Wyoming and Montana. FOB Newcastle is the price of coal at a major trading hub in Australia. And FOB Qinhuangdao is the price of coal at a major trading hub in China. So as we saw Henry Hub start to pull below these major coal contracts just in the last 9 months, so it's a relatively new phenomenon, we've got to start thinking about this on the horizon. And I know from Dr. Rai, there have been a number of discussions about shale gas. I won't go into great detail there. But what we do know, or we think we're starting to see, is that there is potential for the U.S. shale gas story to be repeated globally. The U.S. EIA now thinks that China's shale gas resource, granted none of this is proven in terms of economically recoverable reserves, is 50% greater than the U.S.'s. So if we see an expansion of shale gas, we could start to have to rethink some of these key energy relationships and how coal fits in that picture. And I just want to highlight a couple of those here. When we think about this massive shift in world energy supplies away from oil and power generation to coal, that was in essence a big reoptimization of the global energy portfolio that was a pretty clear price and security arbitrage. There are a couple other up here that might be similarly disruptive if they continue going forward. One is the relationship between Asian LNG, so the price Asia pays for gas in the world market, which is oil indexed. That's why it's essentially at the level that you see Brent for oil, and US gas. That's a huge differential. So what we're starting to see now is movement from US-based LNG companies to export US gas to essentially trade that spread, right? You can't do that on a screen. You have to build a $3 billion LNG terminal. It's kind of complicated. We won't get into that. But nonetheless, the spread is just to indicate the value on the table. And when that much value is on the table, just like that difference between coal and oil, you start to see some of these markets move. That, if it happens, all else equal, might pull up the US gas price and again reorient the relationship to gas between coal. But coal has a bit of an ace up its sleeve. Even if the shale gas story can disrupt the relationship of coal to gas in a lot of these markets, which would be potentially a massive gain for climate because gas, of course, is 50% the CO2 intensity of coal when burned in a power plant. There are a lot of really, really cheap coal resources around the world that haven't been tapped yet. And those are essentially low-quality coals and lignites. The U.S. Powder River Basin is a great example. And you can see why a lot of companies in the U.S., Peabody, Arch, and the major coal producers, want to send U.S. coal to Asia. It's because that gap is a great trade. So that's just a look at a very high level at what's going on in the global coal markets. As I said, those markets are really linked to a lot of the major domestic markets. The key markets there being India and China, where production in those markets is much larger, actually, than the amount traded globally. So what we're going to do is drill down on China and talk about not only what's going on in its major energy markets, its coal and power sectors, but what those developments might mean for climate change and for coal. So just to get some of the basic facts out there, I think everybody's more or less familiar with this story on a macro level. An impressive expansion of Chinese coal production in the last 10 years, which is getting close to this year 4 billion tons a year on a volume basis, not an energy-adjusted basis. What's really driving that? Well, as we indicated earlier, it's demand for electricity. A lot of the world does not yet have access to basic goods and services that require power. China, of course, is electrifying at a very quick rate. You see here the growth of installed coal capacity really jumping after 2003, 2004. And just to make note of what else is in the mix, you also see a pretty significant contribution of hydropower, which has its own constraints and interesting issues. And finally, in the last couple of years, nuclear and wind and other renewables starting to make a small contribution. So before we really drill down on the Chinese power sector, I want to tee up some of the forces that are really driving the massive transformations we're seeing right now in Chinese energy, right? And that is a fundamental imbalance between the reforms and the regulations and the rules and the pricing between the coal sector, which you see on top, and the power sector, which you see on bottom. So obviously China is starting from a point in the 50s of entirely planned state economy. And what happened in the coal sector for a number of reasons was a gradual relaxing and liberalization of the state planning apparatus. And that took a long time, and there were a number of phases. But what happened over time is we've gotten to a place now where there is still some limited intervention and control by the Chinese government of the coal price and the coal markets. And in fact, the Chinese government owns a large share of the coal producers. But for the most part, there is a market price of coal in China that is not directly controlled by the government. That's going to become really important in a minute, and we'll see why. What we're going to contrast that to is the state of the Chinese power sector, right? So electricity generation in China. That sector is still very tightly controlled, and power prices are capped at artificially low levels. So the story that you've heard about liberalization of EU or US power sectors, perhaps some of you follow power prices in ERCOT, that does not happen in China. There is a bureaucracy that decides the price based on a number of concerns which have very little to do with the input costs of electricity. So starting with the power sector, what we are seeing now is a slow but significant diversification away from coal. If this continues, of course, this is a positive thing for the climate. So let's look at what's going on and what's driving that. As I mentioned, the imbalance between the coal and power sectors is really a driving force here. What you see in this chart is the price of coal in terms of its cost on a kilowatt basis compared to what you see as the very much capped wholesale price of power. So what can you take away from this chart? What you can take away is that if you are a power generator in China and you want to make electricity, you go out and buy a ton of coal. You have lost money before you have financed or built a power plant or hired staff to run it, all of which are expensive propositions. So in the term of power markets, generation margins are negative. That is fundamentally a huge dislocation in the Chinese economy that's driving a lot of problems, one of the most dramatic of which is the big state-owned companies that control the majority of the Chinese power sector are losing a lot of money. okay? In the end of the day, do they go bankrupt? Do they shut down? No. They're owned by the Chinese government. And what's going on here, if we step back and think about it in a sort of more macro context, I'll just make this comment briefly, but I view this phenomenon essentially as a cross-subsidization of the economic growth strategy, right? If you can maintain artificially cheap inputs into industrial production, guess what? The Chinese economy is dominated by industrial growth. You're going to attract a lot of foreign investment, you're going to employ a lot of people, and you're going to make a lot of the world's goods in China. You're also going to keep inflation low, which is the primary concern of planners in Beijing, and you're going to keep the population happy. So in the end, there's no data on this, but my view is the Chinese government feels they're making this back and more, even if they have to keep these companies whole at the end of the year. But that being said, these losses are getting bigger, and there will be a breaking point, and we're starting to see the pressure really mount here. So on top of those real price pressures in the system, the power sector can't pay for itself in terms of its coal assets. We also have the obvious environmental challenges posed by coal. And if any of you have ever been to China, you've probably got a little bit left in your lungs. You know what those are. That's NOx, that's SOx, that's mercury, that's particulate matter. It's all kinds of things. It's mining deaths in the thousands every year. So there are a number of environmental and social costs here in addition to the price incentive to really diversify away from coal. I think people that I often talk to demonize China as this coal-hungry monster that just can't get enough coal. It's a coal addiction. Really, they have every incentive in the world to break that coal addiction, and they are trying as hard as they can. The issue is, what else do you substitute? That's the key constraint, right? So if you look at the key Chinese energy targets, the target is to have 15% non-fossil energy by 2020. What is that going to come from? Well, it's probably going to come from nuclear and hydro, which are the two things that give baseload power and scale the fastest. That's why it says non-fossil instead of renewable, right? Key distinction there. Wind growth, however, has been a great success story in China, albeit some problems with connecting to the grid. But keep in mind, given the capacity factors of wind and coal in China, it takes 2 gigawatts of wind to make up for 1 gigawatt of coal generation. And solar is somewhere between 2 to 3 times out of the money against coal on the Chinese grid. But the trend line that we see here is the share of new capacity, so new gigawatts in the Chinese market since 2007, as you see in the red line, is declining. It was about 81% in 2007, and it's gone down to about 64% last year. So coal, by far, still the largest absolute contribution, but that share declining as things like hydro, nuclear, and a little bit of renewables work their way into the system. So that, I think, is, for those of you who care about climate, a positive story, albeit a very complex one, and we'll have to see how those pressures really drive the system in terms of power and coal going forward. Looking at the other side of the equation in China, the coal market, we can take away a few different lessons. And I think we have to start with this. This is the highest coal price in the world, okay? China is not gorging itself on infinite quantities of cheap coal. This is very expensive stuff, and that's what's driving a lot of the losses that we saw earlier. Why is it so expensive? Historically, there's been a very fragmented production structure. You had a number of state-controlled companies. You had limited private involvement. But if you look at the green there, what TVEs represents is township and village enterprises. So that more or less translates to a gentleman who comes out of his village with a shovel and jumps in a mine, okay? That type of production has contributed to a large share, up to 50% of Chinese coal historically, and even then is probably statistically underrepresented because the Chinese planners will tell you themselves they have no way of accurately counting how much coal these folks are producing, and it's probably 300-ish million tons undercounted. So that is an expensive way to get your coal, and it's dangerous. A lot of people get hurt doing that. It's environmentally suboptimal. and adds to significant costs. What's another key issue that's the cause of that coal price we saw earlier? The transportation networks in China cannot keep up with coal production and coal demand. Why is that? The rail network, which is traditionally used to transport coal, is controlled by a state monopoly. Many of you may have seen there was criticism of that monopoly after the recent high-speed rail crash in Beijing. But I think that just indicates at a surface level how bureaucratic and how, let's just say, suboptimally managed the rail network is in China. So what has that resulted in? So the first bar you see on the left is actually the cost of coal in major mining areas in China. So that's about, let's call it 250 RMB. Well, adding on the transport cost, because the rail networks are maxed out and you've got to send trucks full of coal on the highway for 1,000 kilometers, adds something like 300 RMB to your price. Then you've got port charges, and 500 million tons of Chinese coal are shipped along the coast in ships because there's not enough rail capacity to move it by rail. You add shipping costs, taxes, and you're pretty far from where you started at the mine when you get to that final coal price. So what does that mean? There's a huge incentive to reform the Chinese rail network. That also, as well as reforming the fragmented production structure we saw in the last slide, could help really purge a lot of the major costs out of the Chinese coal price. So we're seeing that now. Targets to expand the rail capacity by 50% by 2015. And if that happens, you would see that wedge come down significantly, and that would result in a significant drop in Chinese coal prices, all else equal. So when we think about these pressures in the coal system and how China is reacting in its energy markets and its laws and its policies and in terms of management of its economy, how is it dealing with these stresses? The imbalance between coal and power, the inability of the transport system to keep up, the high coal price. It's working on a solution that in English translates to more or less coal-powered bases. And here, this is kind of a tough chart to read, trying to turn sort of a Chinese coal geology chart into a coal power base chart. But the point here is what you see is 14 coal power bases, more or less sited on top of the major coal deposits in China. Why would you do that? If you can site coal-consuming assets, power plants, chemical facilities, etc., on top of the coal mine, just from a geographical perspective, you accomplish a couple of things. One, you reduce that transport constraint that we saw in the rail networks that's so expensive, right? You get your coal right on top of the mine. But if we think about the ownership structure, which is the other key part of these coal power bases that's being put in place, China is going to vertically integrate the coal producers and the power producers under government control at these sites. So what does that mean? It means that whereas the government SOEs, state-owned enterprises, that were losing so much money, as we saw a few slides back, were paying something close to market prices for coal. If the government reasserts control over the coal assets and consolidates them literally and in terms of corporate structure underneath the power companies, these power companies are no longer going to pay market prices for coal. We're going to have something like a two-track system where there is a market price, but the strategically important state-owned firms pay an internal transfer price much closer to cost at the mine, which could reduce that coal price that the Chinese economy is paying by somewhere between 30 to 60%. So just to hit on the key objectives of that policy, now that we have a rough sense of what it looks like physically and in terms of ownership structure, there's a great quote there from one of the heads of Chinese energy planning. They are doing this to essentially integrate all these industries in one place and reassert government control over these industries. So the pendulum of state control is swinging, in this case, not towards liberalization, as we see in other parts of the Chinese economy, but back towards control. So that, as I said, results theoretically in what we see at the bottom, which is significant cost reductions for the Chinese energy sector. So this trend really works against the sort of climate trend that we saw from the power sector reform. If you make coal cheaper, if you achieve massive economies of scale and you make sure that 50% of the market doesn't have to pay market prices for coal, you essentially allow coal demand to escalate much faster. Now, coal demand itself is a complex thing, but what we would see if this came into reality, according to Beijing's targets, is 90% of all coal production under coal power bases by the end of the 12-year plan. That is a wholesale restructuring of the Chinese energy sector. That would be akin to me saying the ownership and physical optimization of the entire U.S. electricity grid and most of the energy that goes into it is going to be reorganized. In fact, if you take just the target for the 10 largest companies there alone, that coal production that they would control is bigger than all the coal produced in the United States. So if we look at those two trends, what we see in China is the power sector reforms diversifying away from coal, probably a gradual but positive climate outcome constrained by how fast you can substitute alternatives for coal, which are questions around specific issues in nuclear, wind, and hydro. But we saw sort of a counterbalancing trend on coal, which is a restructuring of the coal sector to make coal much cheaper, much easier to get, and easier to burn, right? So these two big trends are kind of weighing against each other in China. So in the context of this, we're continuing to see rapid growth of coal markets. China is going to continue to add a majority of coal as its new capacity in the years to come. And as we pointed out in the beginning, the problem for folks concerned about climate is climate policy is not really doing anything about any of this in a meaningful way. So what I want to suggest is kind of a new framework for thinking about this that can operate, for the most part, with some exceptions, in the markets as they exist now, without or with limited government intervention and subsidy. So I'm going to suggest sort of two frameworks here that have to meet a key criteria. One is they've got to be able to provide reliable, secure baseload power. So does everybody know what baseload power is? Just means it's uninterruptible. You push a button and it's on, right? As opposed to wind, which is intermittent. Okay? Why do you need baseload power in the Chinese economy? Because if you're running an industrialized economy, you need power on 24/7. And right now, renewables aren't in a position to do that at a scale to power the Chinese economy. So you need something like a hydro asset, a nuclear asset, a gas asset, or a coal asset, okay? So with that in mind as the key constraint here, what can we think about as two strategies to get at this problem in the current markets, absent climate policy? The first one I'm going to suggest is substitution. Pretty straightforward. Utilize less carbon-intensive baseload alternatives to coal that exist now. And the second one is decoupling, which is if we assume coal demand growth and coal consumption is going to continue racing ahead, which I'm arguing is the assumption we should make, then how can we think about decoupling emissions growth from coal demand growth? And how might we do that? So starting with substitution, here you see what the real existing portfolio of baseload alternatives to coal generation would look like. And what I've compared here is the capital cost against the emissions profile of those assets. So advanced NGCC is natural gas combined cycle. We've got a lot of that in the US. It's cheap and it's got a great emissions profile. The issue in the developing world is, can you get the gas? China historically, for instance, has not, and India as well, has not had the domestic gas supply to support a significant amount of gas in the power sector. I think last time I looked, the amount of gas in the Chinese power sector was something like 25 gigawatts. It's tiny, right? It's 2.5%, roughly. So if the story changes around shale gas, that's a big deal because you can start to substitute these types of power plants into economies like China and India, where the key constraint has just been lack of availability of fuel. The second one here is advanced pulverized coal. We'll hit on that in more detail in a minute, but that's essentially a more efficient coal plant than the plants that are subcritical coal plants operating in most of the developing world. IGCC, integrated gasification combined cycle, that's a technology that gasifies coal, then runs it in something like a gas turbine. That's great if you want, what I'm calling here a CCS call option. So CCS, carbon capture and sequestration, not really ready to be deployed yet on existing coal assets, but theoretically, even though there aren't that many IGCC plants deployed around the world, the gasification process actually separates the CO2 in a way that's much cheaper and easier to capture when you combine it with CCS. So if we get to a point where we can deploy CCS, these are the types of coal plants you would like to have in your fleet when you are ready to deploy CCS. That being said, they're more expensive, and there's really only a handful in existence around the world right now. And of course, nuclear everyone's familiar with. Expensive, but where you can do it, the emissions profile out of the smokestack is essentially zero. The question there is really around security and technological availability, but the Chinese are now racing ahead with probably the largest nuclear expansion program in history, targeting pre-Fukushima something like 86 gigawatts by 2020. So that portfolio is technologies you can go buy from GE or Siemens or whoever today and deploy now if you have the fuel and the capital to make that a reality. So we talked about CCS. I assume everyone is broadly familiar with what that is, carbon capture and sequestration. The idea is you perhaps have to separate CO2 from the smokestack of a power plant. You then condense it and transport it somewhere where you can store it underground, a depleted oil reservoir, a saline aquifer, or a geological formation along those lines. It is a huge solution for the climate problem if you can get it to work, because so many of the world's emissions, as we saw earlier, come from coal plants. The problem so far is it's very expensive. That is so far requiring government support, and there are a number of legal and regulatory frameworks around how to get that done. So what do we have in the meantime if we don't have CCS? Efficiency. What you see on the left side is the average worldwide efficiency of a coal plant. If you start moving that efficiency to EU levels, you have 16% less CO2. If you move it to really the level of the best coal plants in Europe, you're at 10% less than that. And if you add it all up, just using state-of-the-art coal technology, you're getting 40% CO2 reductions over existing assets. Now, you may say that's a bit of a Faustian bargain, because if you build these plants, you are locking in 40 years of coal emissions. But the key question there is, what do you think the counterfactual is? If it is a subcritical coal plant at the 30%, then you're looking at 40% emission savings using current state-of-the-art coal technology. This one is something I'm increasingly getting interested in. It's been around in theory for over 100 years, but underground coal gasification is a technology which, in theory, would create a gasification chamber in a coal seam underground, burn the coal there, and take syngas up to the surface, which can be used in chemicals industry, power industry, and turned into diesel as well. There's some huge advantages if you can get this to work. You increase world coal reserves by 300 to 400%. You leave a lot of the nasty emissions from coal underground. Potentially, you can integrate it with CCS, maybe even put the CO2 back into the coal seam that you just burned. And I think we have to take these numbers with a grain of salt, but if it can be optimized, it's potentially cheaper than shale gas. The key risk that's been identified so far is some of the trials that happened and ended in the 70s, and one that happened this year in Australia resulted in some groundwater contamination of some very toxic chemicals. There are some US national labs that are now saying that can be avoided, but the interesting thing about this is it's very transformational if it works. It hasn't quite crossed the threshold in the last 100 years, but we're now seeing a new wave of investment and interest in research across the world, and the advances in drilling technology, both in oil and gas, may provide new cost advantages and advancements to underground coal gasification that potentially could push this over the threshold and make it a really transformative energy technology that doesn't require CO2 pricing. So to wrap it up, here are some of the key points we've hit on. And we've touched on a lot of issues, some of which just barely, and I'm happy to go into in more detail in the Q&A, but I'll leave those up there. But really, what I'm suggesting is that it is absolutely necessary for those folks concerned about climate to, A, think about coal. As I said, it's not sexy, but it's damn important. I think, I'm in Silicon Valley. I hear a lot about renewables. I used to trade renewable energy. That's great. But if you are thinking about climate change on a dollars per ton mitigation basis, which is a least cost mitigation solution basis, you should be thinking about coal. And what I'm also suggesting is that the Chinese markets and what's happening in the Chinese markets are central to this problem. We should also really be thinking deeply about the Chinese markets and trying to come up with solutions that can be deployed absent climate policy, absent CO2 pricing. Some caveats there. I'm not going to claim CCS is quite to that level. But I would argue it's time to rethink the climate challenge, both in terms of coal and in terms of the solutions that are in the policy and technological toolkit that we can deploy in markets as they exist today without government intervention. So that's where I'll leave it for now. Thanks very much, and I'll take your questions.
We have time for some questions.
Yeah, is it on? Okay. Yeah, just two quick questions. One, how much of coal demand in China now is attributed to base metal production and methanol production, and how is government policy kind of affecting that over the next few years? Is demand for that in that area also increasing? And secondly, do you see it realistic at all that China could make a deal with Russia to import significant volumes of gas and therefore build up the gas-fired sector?
Yeah. Oh, great question. So with regard to coal demand from the steel sectors and the chemical sectors, we are seeing a really big push in China to develop assets that can convert coal into a number of chemicals. So CTL, coal to liquids, which is a diesel substitute, an output of that. Coal to methanol, certainly on that list, as well as coal to olefins and a number of other chemicals. There's a big push right now to convert coal and use coal as a feedstock for all those chemical processes. A lot of investment happening to build the assets to make that a reality. In terms of the coking coal demand in China, China has historically imported a large share of its coking coal because the coal quality in China hasn't been quite high enough to satisfy the entire coking coal demand in China. But you can think about that as broadly correlated to the construction sector in China because it's going into steel demand. So this also in the press quite a bit. The sort of lending climate and potential real estate bubble around coal is really tied to that steelmaking demand, and what we see happening in the steel sector will be tied to pretty directly to the construction sector. So that'll be something to watch, and it's a great debate right now. I mean, sort of real estate bubble or not in China, a lot of very sharp economists having that debate right now. So I think that'll be a key thing to watch in terms of coking coal demand. And the last piece was the gas pipeline. So we've seen three, I believe we're on the third west-to-east pipeline from Turkmenistan, which is in the pipeline now. We've seen China willing and able to negotiate major gas deals via pipeline with Central Asia. Of course, the negotiations with Russia, Putin, I believe, was just in China. An ongoing sticking point is what the price is there. Chinese gas markets are much less liberalized than Chinese coal markets. Those prices are strictly controlled. Also, production is much less fragmented than in the coal sector, and a few companies really control most of the gas production in China. So the Russians have, again, sort of an arbitrage question in front of them, which is they can send gas to Europe or to China. And the gas they're sending to Europe right now is more or less oil linked, while Chinese gas price is artificially low. So the Chinese, the Russians are coming from this place where they're expecting something like oil parity. And the Chinese are coming from this place where they've got artificially capped gas prices on the wholesale and retail level. So any gap between what the Chinese pay for it from the Russians and the retail price will have to be paid by the government. I expect there will be a gap. The real sticking point over is how big is that gap? And I think my view is that's what's been the sticking point between Putin and the Chinese negotiators.
Question?
So in the scenario that there's really no international binding agreement for managing greenhouse gas emissions, what incentive would countries or firms have to incorporate technologies such as CCS, given that it does make the energy that comes out of coal more expensive?
Yeah, that's a great question, and it's something that Dr. Ryan and I looked at together in the context of China, and what we argued was, absent a significant CO2 price, there's actually very little incentive for countries like China and India to deploy CCS on a large scale. There are a few niche applications, and I could cycle back to this sort of world. I didn't talk too much about this, but what this is from the World CCS Institute, a breakdown of where CCS really is in the world. I think what you really have to look at is the orange, which is somewhere in the reality zone. The rest is somewhere in the planning zone. We've seen with CCS projects that they get pretty far down the planning zone and disappear. That's happened a number of times in Europe and certainly in the US. So there's an energy penalty. Most studies put the cost of CCS in terms of CO2 somewhere between $50 and $150 a ton. So unless you find either a cheap source for the CO2, which is probably not going to be coal-fired power plants, it may be gasification processes which already have a pure stream. Therefore, your cost will be lower because you don't have to separate the CO2 from other emissions. That might be a niche, as well as places where you can use the CO2 in things like enhanced oil recovery, therefore get some value for the CO2 that's not a policy-dictated price for carbon. But the short answer is, absent a price for carbon, it's probably not going to be widely deployed in the power sector, though we may see some niche applications in industrial processes and enhanced oil recovery.
Over here, thank you. So we're subsidizing a lot of investment in renewable energies, particularly in America. It seems like we should be subsidizing mitigation strategies for coal. Is that going on in the United States that you know of? And if not, what other technologies outside of CCS could we invest in? And then if coal becomes a global market, will that help? How will that influence the incentives to subsidize or invest in mitigation strategies?
So, hitting the last one first, it's hard to say in terms of the integration of the global market how that would affect mitigation strategies in its own right. What we can say is, if things like, a good example of one possible effect is, if that arbitrage between Western U.S. coal and Chinese coal is realized, what you will see is the price of U.S. coal potentially go up. Because essentially what you'll have is the Chinese bidding U.S. coal offshore, right? That's an example of a linkage which I have argued is potentially beneficial for net CO2 emissions, because the Chinese are going to use the same amount of coal no matter what. They don't have great switching options to natural gas yet. Yet, if the Chinese bid up U.S. coal, there's large potential, given where gas prices are, for coal-gas switch in the U.S., which could be a net gain. So you have to kind of evaluate that on a case-by-case basis, right? There may be other situations in which linking these markets provides certain power sectors much cheaper coal. So we could see the opposite effect. So that's a case-by-case basis. But in the context where prices get higher, not only do we have the opportunity for coal-gas switch in markets that have gas, so Europe and the U.S. mostly, Australia as well, certainly efficiency becomes a more attractive proposition. And then your first question, I forgot, was about focusing on mitigation strategies for coal. So the key distinction there is, and I didn't talk too much about the U.S., there's a lot of interesting things going on, is whether we want to target those at the U.S. I think actually the outlook for coal in the U.S. right now is quite dire, and that's another reason why you see these U.S. coal companies trying to move coal overseas. Part of that is a story which it sounds like there's a talk on next week, EPA regulations of the power sector. really interesting issue. Current forecasts are putting projected retirements from the new EPA regulations that's in the U.S. at somewhere between 10 and 75 gigawatts of coal capacity. So that's happening. Also, $3.50 gas is driving a lot of coal gas switch in the U.S. So, you know, the outlook for coal demand in the U.S., I would say, is quite bearish already. And I think really the biggest mitigation opportunity you're going to see in the coal space in the U.S. is that coal gas switch. Globally, it gets to be a really interesting question of how you start to create international policy mechanisms or markets or other incentives that might drive these kinds of mitigation opportunities. And I think I'll make a point, again, something Dr. Raya has worked on. The place to start is where you don't have to do any of that because the opportunity is aligned with the incentives in the developing country. So we've seen actually things like underground coal gasification. India and China are arguably have been more active, much more active. I think China's had something like 30 demonstration or trial projects in the last 20 years because that's actually a huge advantage for them in terms of their diversifying their own energy portfolio, reducing their own emissions to get that done. So, you know, the State Department has some arrangements. They've got a U.S.-China Shale Gas initiative. That's another one that doesn't require mechanisms like we saw in Kyoto, like the Clean Development Mechanism, that actually transfer money. So there are those kinds of mechanisms. There are interesting questions about what happens after the CDM, but rather than emphasize those, I would suggest the right place to start is where the existing incentives in the host country are already aligned with these goals and these technologies, and you don't, in a climate of global austerity, have to look at justifying to voters a wealth transfer from the U.S. to China.
Last question here, and then.
Yeah, I was hoping you could talk a little bit more about the shale gas influence. We've seen a number of deals in the last year and beyond of China with U.S. gas companies about developing hydrofracking and other techniques to produce out of those shale deposits.
Right.
And I guess the other question is, given the lag time to building a gas-powered plant versus coal-powered plant, where are they currently investing right now? Are they still investing with great zeal in the coal-powered, or is that shift starting to happen in China the way it is here, where the new electricity generation is really going for gas?
That's a great question, and I think will be a key question for Chinese emissions in the next 10 to 15 years is to what degree can gas penetrate the power sector. Thus far, it's been very limited. As I said, there's something, I believe the number's around, it's probably approaching 30, but let's call it 25 to 30 gigawatts of gas in a power sector that's approaching 1 billion gigawatts, so very small. Why is that the case? The first point is limited domestic gas production historically. And secondly, the gas that did exist has been preferenced for other uses besides power politically. So it's not an open gas market in the sense that there's an index at Henry Hub. You can bid for it. If you pay for it, it's yours. Actually, there are political tiers of who gets the gas. And historically, the power sector's been at the bottom after industry and agriculture. So supply not only has to be expanded enough to, I mean, it really has to satisfy these other politically preferenced industries before it gets to power. The caveat there is the sensitivity and the policy focus on emissions, particularly NOx and SOx and other particulates, is really growing. And gas is a good way to deal with that. So the incentives to boost power in the hierarchy in terms of who gets gas, I would say, are increasing. But the really big question is, what is the shale gas potential in China? We've got early signs that it is significant, but we've just seen in the last couple of months the first shale gas block get auctioned for exploration. So at this stage, it's really still a big question mark, but a crucially important one.
So a couple questions. So the Chinese central bank has, okay, sorry. The Chinese central bank has, what, $3 trillion in reserves through various mechanisms of pegging currency. So could they use any of that $3 trillion? And if they could for some of these investments, why is money even an object with that much in reserves that could be displaced? And secondly, going back to one of your earlier points about energy becoming asset classes versus, is a solution for that? I know there are various debates about adding liquidity through speculation derivatives versus adding volatility, and where's the trade-off? Is just making them have decent margin requirements the solution, or what's your view on that too? So 2 questions.
I think clearly China's in an enviable financial position. We have seen them build a lot of power plants that are loss-making. I think that's a clear indication of the fact that they're willing to spend money on power assets that they view as strategically or politically important, even if they're loss-making. The question is, how much are they willing to spend for what they view as environmentally important? That is increasing. They've put actually a premium in the wholesale power market on power plants that install FGD, which controls SOx. So that's a small premium, but you're starting to see little adders for costlier environmental technologies in China. It is happening. Regarding the financialization of coal, it's a very controversial debate. I won't pretend that there's a consensus answer on that in terms of the impact of financial mechanisms and whether the added liquidity from things like exchange-traded products and the new funds that have kind of, let's call it, democratized oil exposure. 5 years ago, if you wanted to go long oil, that would have been tricky. Today, I can probably do it off my phone. I think, it's a highly contested question. And I'm not going to tell you the answer today because it probably gets into a longer discussion than we have. If you want to talk after, there's some great research on that question. I think coal is going that way. My own view on coal is that the financialization of coal will have new impacts on global coal price formation, although I think it's too early to make a sort of normative judgment about whether that's good or bad. Thanks a lot. Awesome. Thank you.